Hi, Jeff Higley with Hotel News Now. We're here at the Hunter Hotel Investment Conference in Atlanta, sitting with Michael Medzigian, the President and CEO of Carey Watermark Investors. Michael, thanks for taking the time.
Thanks, Jeff.
Tell me, how do you characterize your buying strategy in this day and age?
Well, it's a little bit different. We call it a growth and income strategy, and if you look around the industry, you've got some that like doing value add projects where they, renovation, rebranding, construction, those kinds of things. You've got others that generally falls in the private equity firms. You've got others like the public REITs that often buy more stabilized assets. We do both, and the reason being we like those value add opportunities to hopefully create value, capital appreciation over time. We like those more stabilized opportunities for current income.
So is there an ideal mix of those, 50-50 for what your portfolio is, or just what's available?
Our investors have asked me that question. It sort of, as portfolios build, you may have more of one than the other, and then you go and try to balance it out. Whether it's 50-40 or 50-50, 60-40, something in that kind of range, we're trying to keep a balance. We're an urban and a resort investor, and in the urban markets, both full service and select service. So really three things: select service hotels in urban markets, full service hotels in urban markets, and resorts. And one of the interesting things about full service hotels and resorts is there's very little new supply, as you know, especially in the resort space. Those are very difficult properties to build. Even in the urban full service space, I mean, there's some development going on, but I think this is probably a Smith Travel piece of data that we use. I think last year there might have only been 2 hotels delivered in the United States with more than 50,000 square feet of meeting space. So we've been very active in that space, and we like the barriers to entry. I think people want to be back in the city. It's where, sort of the technology hubs are. It's where the intellectual capital is. So it's not just in the hotel space. I think it's, whether it's multifamily, condo, rental, office. I think the suburbs have probably not fared as well in this recovery as the cities have, and hotels are no different. We certainly get comfort from a lot of demand sources, which you get in a larger market, but we're not tied into sort of New York, Boston, DC, San Francisco, LA. We're definitely going beyond that.
You're a publicly registered REIT, not a publicly traded REIT. So does that give you an advantage of any sorts, or what is your advantage in the market?
I guess we've got the luxury, as compared with the publicly traded REITs, of building out the portfolio in a way that we think is appropriate. There aren't analyst reports that are written on us each quarter. So we're running the business in a way that we think is best for building the business. There are different times and cycles where the analysts, I guess, reward or penalize the public REITs for different things. They might feel, when this recovery first started, there was a very strong focus on, again, New York, Boston, San Francisco, really being in a very narrow band of markets. That might be right, it might not be right. So we're kind of focused on what we think is the best way to build the business.